Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
By examining what the slower paced moves are within this trading range, you can often get that heads up. So it gives you an idea of not only which direction that range is most likely to break, but also how quickly that range can break. For instance, if you have a trading range that, let's say we have this nice sideways range here, but it comes from the lower end of the range and just breaks through that high of the range here. Notice there wasn't really any substantial change in momentum within the range itself. There was a little bit of a slowdown on that last pullback, but not anything great. And so what tends to happen in a situation like that is that even though it penetrates this upper end of the trading range, or it seems to do so, it can have a much more difficult time really continuing to follow through, particularly if it had retraced all the way back to the low of that range before it did so. So this is an instance where a lot of times you would see another correction, something coming back into the range, before it's able to continue on the previous breakout direction, or it might come back in and the pace might shift again and be a failure. So a lot of times you can get trap patterns that will form in this way as well, where because you have the move all the way from the bottom of the range to the top, it tests that zone of resistance, but it still holds that zone and eventually comes back in, turns back around, and breaks lower just like it does over here on K. Now, as I said before, slower than average moves are often going to lead to continuations of the previous trend. So if you have a sharp upside move, and then you have a slower than average move on the pullback, then that's most likely to lead to a continuation of that previous trend, unless there's some sort of change in momentum within this trading range itself. Here's a good example of this on one of the charts from USD JPY that you guys saw in the last presentation. Notice that there was sort of a rollover here at highs late last year, and then the momentum shifted strongly on the downside. Now, because there was a slow, gradual sideways move here, this created a shift in momentum that favored a stronger breakdown than any other direction. So, because of the gradual move sideways with only a very slight upside tilt, it was able to break more easily to the downside than be able to continue to reverse and bounce and head back higher. And the same thing happened over here with B. Again, a slower, more gradual move on sideways, more easily broke to the downside. And the same thing here with C as well. Stronger downside move overall, more gradual sideways move led to a continuation of the downside. Now, stronger than average moves, however, are going to tend to correct more slowly. So, like you have that stronger than average upside move, chances are it's going to have more of a gradual pullback. Now, that slowdown doesn't necessarily have to be a pullback in terms of price or a gradual correction in terms of price. For instance, what could happen, let me see if I can clear this here. Let me select the eraser. Okay, there we go. What could happen is that if you have a sharp upside move, maybe how it corrects is it begins to shift pace at the highs. So the momentum will start to roll over like this. And when you have that happen again, you have a more gradual upside move now, which can more easily break and roll over and turn down to the downside. So again, if we have the sharp moves on the downside, they're more likely to correct more gradually. Very easy concept, but until I actually began giving presentations on it, most of the people in the presentations had never even heard of such a concept. And you're going to find that once you begin to apply this concept to your trading, it's going to make quite a dramatic difference in terms of what you're able to see and what you're able to predict. I began to teach this concept about 5 or 6 years ago, and it just really amazed me that there wasn't anything ever discussed in the literature about it, because it seems like once you know what it is, it's one of those things like, why did I not think of this before? Or how could nobody else have thought of this before? And I'm sure that people do. It's just that it's not something that had really been written about or taught. I came across trading a little bit different background than a lot of people. I kind of was introduced to it through another person, and he gave me a couple of books to read and said, here, learn about the market. This is going to tell you what to do. And back in the day, well, it was about 12 years ago, so, it's not like 100, 200 years ago or so, but there wasn't really much out there on technical analysis. I mean, you had some basic ideas, concepts on candlestick charting and that type of thing. But now there's such a plethora of education out there. It's just amazing how fast this area has developed over just the last 10 years. But back at the time, a lot of the books that were written really tied more into fundamental analysis. It was more of the things like CanSlim and O'Neill, that type of trading methodology, and it wasn't really aimed as much for the online trader, because online trading was really a brand new concept. But I quickly found out that, trying to learn a lot of the indicators and the things that were out there and that were in a lot of these charting packages and that type of stuff, it was just really confusing. And I noticed that you could actually pick out the patterns and the development of a stock or of any security really just by looking at the simple things like price and volume and not really paying any attention to a lot of other indicators, which a lot of times if you weren't really a proficionado at the indicator itself, you would have a lot of false indications of which direction to go, and it became confusing. So by just getting rid of those and focusing upon price action, one of the things that really became clear was just how important this concept of momentum really was, this concept of pace. Now, there are things out there like momentum oscillators, that type of stuff, but I don't really use that at all either. I'm just focusing upon comparing what the current market action, the current price action is in a security to what's happened in the past. So if you have trading ranges, for instance, where you have a V type of situation, often that's going to hold the zone of a previous high, and it's going to lead to some sort of longer congestion. Now, maybe it plays out with a more gradual pullback like this, which allows it to break higher, but in either case, it's usually going to pull it back into that range to some extent. So here's a good example of it. We have this V formation here, holds the zone of this previous high, pulls back lower, and then holds the zone of this previous low. And then the momentum shifts at that previous low and allows for a stronger breakdown. Now, a third thing that I look at that's another building block, just like these support and resistance levels are and just like the concept of pace or momentum is what's going on in the trend. And so I'm looking at the nature of a trend. Trend, very simply, is just the primary direction of price movement at any time. They're repetitive, but the placement of a pattern in the context of a larger trend is really key to identifying target levels or assessing if the setup's going to be viable in the first place.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.